a request. Check your.
Hold on just half sec. I'll be there in a second.
Okay. Well, we're live, so no pressure, Hike. Just get it together, dude.
Well, you guys are all right. You can get started. I'll be on in just a second. For some reason, I've got Tracy's window open, so it is what it is.
Tracy, thanks for coming on.
Yes, thank you for having me.
Absolutely. We're waiting. Hike's these technical difficulties here. He's gonna log back in here in a second.
I'll be there in just a second. Close a couple things.
You have to go through your phone to do the spaces, right?
Yeah, exactly.
Okay, cool. Just make sure you.
That's what I'm doing. I have to disconnect one Bluetooth and connect another. So
you also have to mute this too, because you're still not muted on the the screen.
I'm muting again.
All right, guys, just give us a couple minutes. We're working through the technical difficulties and we'll get started here.
All right, Tracy and Mac.
I'm going to kick it off. I'll launch with the intro, Hike. Here we go.
Perfect.
My name is Max Scagliardi, and we're here live with co-host David Heikkinen for this week's episode of Talk Energy Insights on January 7th, 2022. And we've got a special guest, Tracy, Shy Girl, here with us. Hike, how's it going?
It's going good. Happy New Year. It's nice to see energy outperforming every other bit of the market. And Pickering, we've worked hard on picking up energy transition just to watch it go into the crapper while oil and gas stocks outperform. So enjoying that as a legacy energy folks, just keep reveling in that. But really, I thought there's a lot of stuff. And Tracy, you posted some interesting stuff on Twitter we can talk through around really where the oil markets are, and then that's dragging the rest of the energy tape higher. I do think there's some weakness in the gas side that could happen through 22 and 23. We could talk through that as well. But right now we're in this like perfect world of an energy crisis, and don't let a good crisis go to waste, where the world is figuring out that underinvestment in oil and gas is starting to lead to escalating pricing. And so appreciate your time. I know you spent a lot of time thinking about this, and for our listeners, we've got both LinkedIn and Twitter. Maybe just a quick introduction would be helpful. You have a large following, and so I think we're getting a lot of people on. But Tracy, if it just hand it off to you and do introductions first, and then we can kind of go into an hour or so of conversation. So appreciate the time on Friday. Happy New Year, everybody.
Absolutely. Thank you guys for having me on. I really, really appreciate it. It is, as far as my background is concerned, quick overview. I started at the Chicago Board of Trade, and I started literally as hawking options, right? Options on futures, and kind of worked my way up. And now where I stand is I have an investment analysis platform with hedge fund telemetry, and I also run a family office oil and gas and materials portfolio.
Yep. And so when you think about your background, and I'm always curious about how people build an online presence and the value of it. And Max and I have now, we're Max is 70 some podcasts in, I'm 30 some in, and so we're kind of thinking through. What made you decide, several years ago to kind of expand and start developing more of a social media following? And you've done a great job, but I'm let's just start there, given where you are.
Well, I started in 2009 on Twitter.
Mm-hmm.
God, it's crazy. And really, it was, because I was at the Board of Trade at the time, and I just kind of wanted. The reason I had Shy Girl and I didn't have anything trading related in my name. Everybody had something trading related in their name. So I kind of wanted to just be anonymous and kind of just eavesdrop on, what traders were doing and sort of, and using it as a news feed because it was, regular news outlets. So I kind of just started that way, and then I just started interacting and talking to people. And I remember, like, when I had 100 followers, I was like, oh my God, 100 people want to hear what I have to say. This is insane. And it, just kind of built from there. Like, it's been a lot of years.
So as you think through where crude markets are now, and so I've talked a lot about the fact that underinvestment and capital is going to lead to north of $100 oil in 2022. The strip is well below it. I'm dragging the Pickering Energy Partners insights and team to above 80. And the question is, as you think about your post from a little bit ago on the kind of triple deficit of where inventories are, in fact, we're using up OPEC plus spare capacity. And then one of the things we talked about last week was that spare capacity or growth sits in the handful of, 3 or 4 OPEC plus nations, and then really, a handful of private companies in the Permian and maybe the majors, but the U.S. independents have capped their growth. So, like, where does supply come from, and how do you turn that lack of spare capacity in the direction of inventories around? And I think the answer is, I'm not going to lead the witness, but I'll let you answer it before I say what I think the answer is.
Well, I mean, we're clearly underfunded, right?
Mm-hmm.
So I think until you have, you're going to see people, or particularly in the United States, people really jumping. I know EOG said today that, they're ready to increase production, but I don't think you're going to see a massive inflow of that kind of attitude, unless we're like $100 plus and for a length of time, like 6 months or more, right? Not just hit it and come back down. I just don't see where companies are going to do that because they're more interested in keeping investors right now, right?
Mm-hmm.
We've already been through 2 crashes. It's the most hated sector of all. It's under 3% weighting in the S&P 500, coming down from 20% at the height. So, oil companies are focusing on paying down debt, discipline.
Go ahead. No, I think it really is like the U.S. So the U.S. independents are, so you take Conoco, which is now the combination of Conoco, Concho, and Shell. You take Pioneer plus Parsley and Double Point. You take Devon plus WPX. All those companies have said the maximum growth they'd ever be is, call it 5%. And then EOG, I know Ezra, and I was in a meeting with them and talked with them. Like, their comment isn't like, they've been consistent for 6 months on saying, if the market calls for growth, EOG will be a growth company. And so EOG is a wild card a little bit. Continental and Harold Hamm is an oil bull. So he bought assets from Pioneer and wants to grow oil. And Max can talk about Continental's Oklahoma City aspirations. But like, they are 100% oil bulls and could grow. But like the U.S. independents that were the shale, like the reason why OPEC Plus was worried was shale was going to overwhelm. It's consolidated so much that I just don't see it. And so like that real term CapEx chart you put out of, dollars of CapEx relative to MBOE, like there's just not the dollars flowing in anymore. And I would argue it's just really like, I can't figure out why oil doesn't go appreciably higher. And it's not at all in the stock.
And I completely agree with you. And and there's also a funding problem too. There's a lack of funding problem, right? So you had the banks, right? The first big shell run, you had the banks all pile in, they got burned. Then you saw private equity come in, they got burned. And now, the banks are scared to touch oil and gas because of the ESG movement, and they're worried about their investors. So, you also have a lack of funding in this industry, and, it's harder and harder to get funding.
Yeah. I just talked to, go ahead, Mac.
Oh, I was going to say, definitely you follow the capital, and I kind of saw this coming like a little bit, ways before, call it 18, 19, and you saw a lot of projections for growth. But even then, I was seeing it more it was in tune with the private equity side and a lot of the smaller mid-sized operators, and you were seeing kind of the funding drying up. 17, 18, they were talking about everybody was going to sell to a public or exit their investment. They'd all been drilling to prove their acreage, and then that didn't happen. There wasn't a lot of those acquisitions, and then they didn't have any money for drilling. And you're watching the smart bank presentations like BP and others. I remember they'd go around to these road shows and be like, here's what's going to happen. And it's like, in terms of, when I say bank, I mean like these markets guys, right? Like predicting the markets. And I'm thinking, well, where's the capital going to come from? And then to all the reasons you guys just mentioned, it's almost just kind of like follow the capital, and it gets you a long ways towards the answer.
I'm curious, Tracy, as you've thought about things, one of the themes that I've been thinking a lot about is this return of capital or return of cash that the upstream companies are going down. And so, it used to be in a commodity rally, you buy the most levered balance sheet, nasty management team that's almost lying to you, crappy Mississippi Lime asset in Northeast Oklahoma, and just hope that oil rallies enough that they'll trigger some rigs and then they get some production growth. Like, I think that trade fails. Like, I think that the generalist is going to go, really long a counterintuitive group that is that group of companies that has a decent balance sheet and is just flowing this cash flow right back to the shareholder. I don't know if you've thought or talked at all about that, but it sure seems like you've got a group of Canadians and E&P companies that oil at 80 and NGL prices where they are, their cash flows are just going to, and then their metrics are just going to flow free cash in. Have you talked much about that with your group or your investors?
Oh, she's requested. Sorry, she dropped off. Let me add her back on. Sorry, Tracy. I didn't notice she popped off. I think you're back.
No problem. I don't know why I got kicked out.
That's weird. You just don't have enough followers, Tracy.
I know.
Did you hear what the last question was from Hike?
Yeah.
No, I did not.
No, I was just talking about, like, how have you thought about the Canadians and U.S. that are like $80 oil and NGL prices where they are and gas prices where they are, just flowing a ton of free cash? Like, we've argued that it used to be buy the crappiest levered company with marginal assets that triggered, and you own those in the 2010 to 2016 time frame. This time, it feels like you just buy quality that's going to give the cash back and let it flow through in dividends, variable dividends, and share repos. I'm curious how you're thinking about that. Do you own quality or do you own nastiness in the oil rally?
I own quality. I'm not gonna lie. I love me some dividends.
Yeah.
So,
okay. There you go.
That's kind of where I sit.
Yeah, it just feels like it's the one. On our last conversation, we talked about that bonds aren't really necessarily giving any real yield, and energy stocks might be the real yield vehicle.
Exactly.
And it's like as an asset class, it's an underappreciated real yield that has some sustainability, particularly with a lack of capital investment. So hopefully
absolutely. And there are so many companies out there that you can find, both in Canada and the United States that offer ridiculous dividends at this point, because that's how they're trying to attract investors. So, you can, it's the first time almost you can literally like buy and sit on it, right? Instead of
No, so it's just interesting, like the 1 month performance of the TAN or the PBW. So these are renewables indices, like down 18, 17% versus
ridiculous.
XOP or even just like S&P flat. But like then you go into the E&P index or the OFS index or the refiners. Like you got these 30% spreads now between what was seen as high quality renewable companies and where the oil, the energy legacy fossil companies are. It's ridiculous. And you haven't in those performance. We think about total return. Like that's just stock depreciation. This isn't talking about 10 to 15%, yields that they, hopefully they'll pay back, 75% of that as opposed to, 40% of it. But like you take a 10, 12%, 15% move plus, 10% yield, now we're talking about huge spreads in just 1 month performance. So when you talk to your family, like you're running money and you're advising people, what does it take to get people? Are they already interested in energy because they're your clients, or are you seeing new people come in?
I would say both. I think it kind of started with people that already liked the industry, but I think the more that I'm out there talking about it, getting people more and more interested, right?
Yeah.
Because I'm kind of, I kind of, as far as an investment perspective is concerned, I mean, this and materials, metals, and agriculture. I mean, I just can't see over, out to 2025 where you could, where this is a bad thing. Like the whole mining sector in general has been underfunded, right? That includes metals. So I think that these sectors in general, and then you have agriculture that is directly affected by energy prices. So I think across the commodity sector, I mean, we're looking at a bull market, 2025, 2030.
No, it's revolutions are started whenever you have food shortages, energy shortages, or bank runs. And energy shortages are typically blackouts. And your chart about where the largest grain importing countries are and kind of that per capita ranking, I thought it was just telling of, that there's just this, people need things that are energy tied and commodity tied. And you look at the lumber prices of where they bottomed in, August of this, like in the peak of the building season, lumber prices bottomed and we're back to the rally. And I'm not at all an expert on the rest of commodities, but I just look at the whole sector. I mean, you're thinking way more broadly, Tracy, than Max or I ever have, but like, it just feels like we have this like wave of demand that is coming, for each one of those root commodities. And we start off every Pickering Energy Partners morning, we have a Tuesday call across our long only group, our private equity group, and our research group of where's copper price. Because I think that wave is coming on the metal side, and gold is, I don't know, Tracy, we haven't talked about gold, and this is totally off base, but I've got some thoughts on gold that, it's more emerging markets driven and not necessarily, really, demand driven. And so like you have, the trade of gold as a wave against inflation, hasn't worked at all. I don't know if you talk much about gold, but other commodities just feel like there's a wave of industrial use that is going to cause a rally.
I sent her, she dropped again. I sent her a co-host invite. I don't know if it's kicking her out because there's too many people in here.
Weird.
That's what would do it, but it said I couldn't invite her. I sent it to her. Just give it a second. Let's see here. Says requested. Oh, she dropped again. It says listener. It says co-host invite. If you can hear us, Tracy, see if you can. Oh, there she goes. Now she's a co-host. Sweet.
Oh, good.
Okay, she's back. Could you hear what we were saying?
Can you hear me now?
We
All
can.
right. So I heard the last part. I mean, as far as the gold market is concerned, I mean, and don't hate me, gold folks. I like gold. I like silver. I think silver has a lot of industrial uses beyond, sort of a monetary or a fiscal hedge or a fiat hedge. But I think the problem with the gold market is that there's too many banks involved, right? And so there's too much manipulation.
Yeah, she's having.
Yeah, I just dropped off too, briefly.
No, you're still on there.
What's going on?
I can see.
No, I had a brief moment of lost and then brought back in. So I don't know what's going on with Twitter Spaces today.
Spaces is unstable. Tracy, can you hear us? I can't hear her. Oh, she's there. Tracy, can you? Come on, Spaces. I don't know. Well, you want us to go for a second? Tracy, I can't hear you if you're talking. Maybe send her a note. Sorry,
I just did.
Sorry, guys. This Spaces is like unstable. Seems to be happening a lot. They got to figure this out. What she was saying was like gold around. She says she likes silver more than gold. It's kind of the fiat hedge. I mean, gold's been just anemic. I mean, what is it, like a negative return over the last 12 months, or is it positive? It's like single digit. It's like single digit over the last 10 years, right?
Gold, the 1 year performance of gold is plus 5%.
Okay, plus 5.
I mean, or no, down. I'm sorry, gold is actually down 6%.
Yeah, down 6%.
Bitcoin's up 5% in a 1 year time frame. And so, like, the reality is those are neck and neck next to each other on my Bloomberg screen. So, sorry for my slight dyslexia there. Yeah, just messaging Tracy. I'm not sure why. I mean, she shows up as a co-host. It's just odd. Yeah, the main thing that we've been trying to think through, and what I wanted to kind of dive into with Tracy, was the broad commodity sector. I mean, she can hear us, but she can't get back in. Maybe Tracy, try leaving. Try leaving and come back in as a listener, and then we can just bring you up to the stage to talk. As maybe
I've got a couple other people that have requested. If you want to, we can bring some on, or you want to just keep it going?
Sure. We can take some questions.
All right, I'm going to add.
Let's take a few questions while we're kind of fumbling through the technology of it.
All right, we got Andrew.
Andrew,
did you just join?
Oh, hey, how are you?
Doing well.
Hey guys, I have a quick suggestion. So I've been getting kicked off Spaces, and someone sent me something saying that there's an issue with the app update where if you change your power preferences, the new default if you have an Android phone is to have a restriction on the amount of power that's allocated to the app, and I guess the Spaces uses a lot of power on the app. So I changed mine, and I've been getting kicked off of Spaces a lot, which is why I think someone mentioned that, and I think that might be a solution there. So anyway, I probably can't even hear me, but I'll try to find what that person had posted and send it over to her. But it seems to be working for me.
Yeah, she said she can hear us, but we can't hear her. I'm going to remove her and then add her again. But Andrew, you just popped up. What do you got? And then we'll go. I can take that, and I'll try to get Tracy back on.
Sure.
Yeah, no, I was just going to say, I mean, I cover the mining space and dangerous and energy here and there. But as far as gold is concerned, if you think about it pretty simply, it does well when growth is decelerating and inflation is decelerating, or it does well when growth is decelerating and inflation is accelerating. So stagflation or deflation. We really haven't been in either one of those regimes for a year. So, and that is the main reason why. The other one is because if you look at ETF holdings, they've been on a straight one-way path from the upper left to the lower right for the entirety of 2021. So there's just a general lack of participation because everything else has been, red hot. Growth has been accelerating above trend, inflation, same position, and that's just not a great backdrop for gold. So, if you look ahead to 2Q possibly, the situation changes a little bit. You have a decel on GDP, even though we're still going to be above trend. Inflation also decelerating, from a high level. So I think that's probably tactically where, you could start to see some relative outperformance. For how long? But that's the thinking at least.
Yeah, I went out and saw an inflation trade and bought a lot of gold and own a lot of energy just because of nature of what I do. And gold seems like emerging markets aren't performing well, and gold correlates with that. And when interest rates are increasing, gold doesn't do well. And so kind of have those two headwinds as well is the only thing that I was going to add. But I really am curious what Tracy would say. Because I really do think
she's back. I think she's back. Tracy, you back?
Yeah, just unmute Tracy. But the rest of the commodity markets, like the rest of metals, I'm curious, Andrew, what do you think happens to copper or any of the other metals?
Yeah, I mean, copper, look, it's less exposed to power. That's why it's underperformed, say, Ali or zinc, for example. But copper, we've done the bottom-up modeling. There's a clear-cut deficit once you get to the middle of the decade. The question is whether or not the market, back up a little bit, you do have a number of projects coming on this year and next year. So the market does get incrementally looser. Does it get demonstrably looser? No. So if you see plus or minus 300,000 tons surplus deficit in copper, it's basically a balanced market. And it's up to macro. What I was going to say is it's unquestionable that there's going to be a deficit around 2025 through the back half of the decade. It's a question of whether or not people front run, like a copper trades higher in front of that, or if we kind of chop around in a big range, say 11,000, 8,500 or 8,000 for the next year or two before we, leg higher. That's our thinking. And aluminum, 30% of the entire European aluminum complex is losing money. Top of the Chinese cost curve is around 3,500, even closer to 4,000. So aluminum is structurally challenged from a cost perspective. And, from a demand standpoint, obviously everything is similar, going to accelerate over the course of the next few years. Chinese property market weakness is definitely a risk, but I think you have clearly a lot less downside relative to steel because the completions for housing starts in China are still going to be strong over the next few years. And so there's relative support there. And then we haven't even talked about carbon, how carbon costs around the world filter into cost curves globally, and all that really does is work to steepen the cost curve. So, in a nutshell, I think this year could just be kind of a consolidation year to a certain extent as the macro kind of weakens a little bit. But I think it's, a buy on dips, multi-year run that we're in.
All right. Thanks, Andrew.
Tracy, you back?
Tracy.
Am I back?
Yeah, you're here.
You are.
Gotcha.
Welcome back.
Woohoo. I did post a chart earlier that I kind of wanted to bring up and talk about as the world investment chart from Goldman Sachs. I think I posted it yesterday. And the problem that I see there is that world investment, has declined in oil and gas, but it has not increased in renewables. So I think on the basis of looking at the energy crisis that we're having in Europe right now, and I've said this repeatedly, that, one, the technology isn't there, two, the investment isn't there. And you can clearly see that. It was a great chart. You can clearly see this where, they're just not energy efficiency, electrical networks, and renewables hasn't really changed over the last 60 years. And at the same time, you're seeing declining investments in oil and gas. So I think we're headed into a real problem until people can kind of change their ideas about this. That's one of the reasons I'm so bullish on the market, because the guys that are left standing, right, because, we saw a lot of bankruptcies and M&As in this industry over the last few years. So I think that the people that are left standing, if you do some
Oh, she cut out again. I don't know, Tracy, maybe it's your service, or maybe switch from Wi-Fi to your phone. But Heike, your thoughts on that, on her last point?
No, I think that the reality of every commodity crisis is there's four characteristics, and they just keep happening. And pre-crisis, you have an erosion of spare capacity. Then you have a failure to appreciate the fact that you're increasing risk by not investing, and then some sort of trigger happens. And I think that's what Tracy is saying about Europe is that potential shortage has now become an actual shortage. And the reality is prices are going to overreact to the upside, and then you're going to have an overinvestment, or there's going to be a fear factor where the market says, gas is unreliable in Europe because price is too volatile and you can't get enough supply, or Russia is too big of a component. But I just think that the commodities across the board, mines take a long time to build. We think that there's this hope. It's like this perfect view of expectations of like, well, we can just wave a magic wand, but the reality is the cycle time on a mine is 4 years to 5 years, and like those are not necessarily all in the most stable countries. And so I just look at the world as kind of this financial stressors of a commodity crisis coming in a lot of different places. The only thing that could change it, and I'm kind of curious at the group, is when I look at China for my entire life essentially has been in a workforce growth mode and was adding millions of people moving into urbanization. And the reality is in the next 3 years, 5 years, 10 years, the workforce in China is actually not growing as much, and that causes a change in their consumption patterns from growing more cities to growing more consumer behaviors. And so it's an interesting question on the commodities of watching China is critical, but then if you swing that the other direction, India is moving into kind of a Chinese growth mode of what happened from kind of 2005 to 2020, and so there's like start focusing on that. I keep seeing these waves, and Mac, you've talked about this a lot, that energy correlates to GDP, which correlates to wealth,
right?
And energy consumption is directly correlative. And so, like, the question is how and where, as you see these waves come, you get a little bit of an ebb of growth in China, but you have this wave of growth in the rest of Southeast Asia that feels almost inevitable, and then the wave after that of sub-Saharan Africa that feels almost inevitable,
right,
from a population growth center. It's this like wave after wave of question.
Yeah, I think no, I agree. I think coming back to Tracy's point around the investment and even on the renewable side, I mean, the biggest thing that I've struck me from the beginning of kind of this push that we've seen, and by the push I mean the ESG movement, but really the lack of investment in oil and gas, coupled with the increased interest or desire to push these renewable projects to the forefront. And the reality is there's real supply chain constraints here. I mean, you just can't, at some level you can make really cheap solar panels or whatever it may be, batteries, you can make them cheap until, but when demand rises like people are forecasting that it needs to bring these technologies online, the supply just isn't there. And to your point around cycle times to get these mines up and going, what this causes, it can cause material disruptions by not having the supply, and it also causes prices to go up for these materials. And so, we talked about it earlier with oil, where we think it's going to go, but let's be real, an $80 barrel of oil today, because of inflation, I don't see this narrative a lot, but you're not, your margin's not the same. And we're seeing supply chain constraints, and we talked about this on our last spaces across the U.S. You got to think these OPEC countries are having that same, those same impacts as well. And so even if we could ramp production, whether it be in fossil fuels or renewables, I don't think the supply chain is going to let us do it to the amount that we need. And even if we did, I think inflation is going to cause the margins at these level of prices to be different than they were prior. So it's almost like a paradigm shift. And I think it's a recipe for prices for energy continue to march up, at least in the near to medium term.
So Tracy, I think you're back on. So we both have advocated you own quality companies that have good distributions and dividends, and just let that return follow into your total return. And as that flows in, I actually think multiples can expand. And so like you got this commodity wave that is a tailwind, you have an inflation wave that is a tailwind, and then you have a group of companies that want to give the cash back to the investor. Like it just almost, and then you have disinterest from most generalists because a price of carbon in these stocks is clearly in there, and so like in the energy stocks, but and tail risk of zero consumption in the future at some point in time for fossils is a worry that people have, but I think it's just unfounded. So I'm looking for people that would argue the opposite on this call of why are we wrong? Because I think Max, Tracy, and I have agreed, and Andrew kind of threw some gas on the metals fire as well of underinvestment. Why is the commodity sector not the place to own? If anybody wants to raise their hand and tell us that answer. Or Tracy, if you have a reason, I'd love to hear your thoughts of why would why would we be mistaken? Essentially, like what would be the where would be our flaw in our logic?
Here she's coming back on. There you go. And I saw someone raising their hand. She keeps getting booted, but I think she's reconnecting. There you go, Tracy. You're back.
Mm-hmm.
All right. Can you hear me?
Yeah, I can hear you.
We can.
Oh, yay. Okay. I don't know why this keeps dropping me.
Yeah, it's weird. I don't know. Did you switch from Wi-Fi to cell or something? I don't know if that's what's causing it, but it seems like even.
No, I'm on my cell.
Yeah. Okay, go ahead. We can hear you now.
Cell. I think it's not great. Also, I kind of missed what you guys were talking about when I was just cut out.
We were going through the commodity cycle of why would we be mistaken? So we had Andrew come on and talk about metals as a wave up. You were hitting grains as a positive sector, and we've hit a lot of the energy or fossil side of having a positive wave. Like, where would we be mistaken? Why would we be wrong that each of these, we don't have this inflationary commodity wave that allows these companies to increase distribution to the investors and return a lot of cash?
I mean, honestly, I don't think the trajectory that we're on, I don't think is stoppable right now, right? We're not going to see a resolution of the supply chain issue coming to, a headway anytime soon. We're not, especially when we have China locked down again. They have 90% of their truck drivers off. I mean, I could list a million examples, but supply chain issue is not coming back. It's not resolving itself anytime soon. So I think really we're on this trajectory that is completely unstoppable. And for anybody to think that this could be resolved within a year after you've shut down the entire planet is ridiculous, because now it's filtering through and we're seeing that, the effects that are completely unstoppable at this point, especially with continued policies like people are continuing.
Yeah.
So I think in general, you're just going to see, there's no way you can convince me right now.
No, she's cutting out. I think it's service. It's got to be service related.
No, but I think where she was going is kind of the same thing that, like, the 2021 lesson was, tightness in the supply chain, led to like opportunities. And like the reality is as you kind of restart every global economy, it almost feels like inevitability of companies generating higher cash flows and therefore higher returns. The only worry that we've had is, is there some sort of execution related issue where companies miss numbers or outspend capitals, or like, is there something that capital really matters in each of these sectors? And what I think is interesting to us is we're covering semiconductors now and covering electric vehicles is, the access to capital for, high tech semis is actually relatively hard, and you're not necessarily making deliveries. And so what's been interesting is, the negative side, so we hit the commodity side positive, but the negative is the rest of the renewable space is underperforming. And it's because it's moving from pre-revenue hopes to, post-revenue actual expectations of can you hit your numbers. And typically it's kind of like exploration in the upstream space. You buy the hope and you sell the reality. And it feels like that's what's flowing through in the market. And so we're in this unique situation. I agree with what Tracy was saying. It's rare. One thing that I know is whenever everybody that's on one side of a trade says, I don't know why this wouldn't happen, I keep looking for reasons why people would say, you guys are wrong and y'all are missing blank. But the commodity side, maybe it's just you just buy the commodity. Maybe you don't own any of the equities and you should just be trading commodities. Maybe that's the angle that you think about, and buying options around commodities is the way to make the most money, which isn't my expertise at all. But the leverage that flows through to a high quality company is going to return a ton of cash. I mean, just buy some upstream companies and buy some midstream companies and, let it flow in.
And oil services.
Well, the large large cap oil services, like oil services, has been the best performing sector year to date.
I know, it's interesting. I know.
It's really, really, really interesting. And there's a market cap weighting. You know, the international services space is doing well, and they've got kind of these latent higher returns. It's totally been that's been a surprise.
That's actually been a very I'm lucky to be in
some of those.
Man, for some reason, it's like every time Tracy comes to talk, it just cuts out.
I was just going to add, as far as the risks, I mean, I think the risks are that you get a start and stop type fiscal. Because a lot of what we're talking about, a lot of the big crack up boom that we saw in demand was completely because, you rewind back to 2009, everybody thought QE was going to be inflationary. That's because all it did was create bank reserves. It never got into people's hands. Well, we know exactly what happens when people actually get the money to spend it. So if that does not continue, then that is the risk. I think there's a big risk in the second half of this year as far as, I talk to people on the ground, whether they're in the steel complex or in copper, especially in the rest of the world. They're not as, orders are not what they were a few months ago. So I think that's the risk. You get more of a start-stop where you have gaps in fiscal, and at the same time, if the energy S&D across the chain, whether it be gas, coal, oil, does not relent in any way, shape, or fashion, then that is the recipe for that is the recipe for weakness. Because that is, and then on top of that, we talk about India, talk about Africa. Unfortunately, they cannot plug the gap that China may leave in the years to come, like in the short term, over the next 2 or 3 years. I mean, the Chinese property market is likely to, housing starts have probably peaked. Completions will probably peak within the next 1 or 2 years. And the trajectory will likely be as quick as it went up, will be as quick as it went down. So I think that's the main risk, the legacy portions of old China infrastructure, like a lot of the new infrastructure that, people are talking about, looking at the credit impulse, this and that. It's softer infrastructure, data centers, it's 5G, it's not building bridges to nowhere, building houses nobody needs. The flip side of all of this is that this cycle versus last cycle is you just don't have the capacity investments across every single chain. Typically when China had a growing population and, people were moving from the rural centers to the urban centers, the whole goal was was employment, And in order to readily employ people, you just build capacity in every single sector that you can imagine. That's why they have overcapacity in steel, chems, manufacturing, everything. Because population growth is now ebbed, or it's actually declining, there's no more need for that. So China's no longer exporting deflation like they did over the last 10 years. So it's a real, unless we get continued fiscal, I think that's the risk. That's the main risk, because honestly, is the organic demand going to be there if energy markets continue to stay tight? I would say that's probably not a good combination. High energy prices and weak fiscal impulse.
Yeah, that's a good point. Wait, Tracy's dropped off again. We've got a number of people with their hands up. I invited Maddie up. I know some of you others had your requested. We'll try to get through some of these. We'll wait and see if Tracy comes back in, but we'll just keep going here for another probably 15, 20 minutes. Maddie, what do you got?
What's up, everybody? Sorry, probably most of you guys don't know who I am, but I'm a petroleum engineer with one of the super major oil companies based out of Houston, Texas. Just wanted to say hello and just pick your guys' brain with respect to the large cap upstream companies that we kind of have, mostly focusing on just from a chart price, stock price sort of look at Exxon, Shell, and BP. I just find it very interesting comparing to where the stocks were at about 2018 timeframe and compared to where the oil price was back in the 2018 timeframe. Oil price being high 60s from a West Texas Intermediate perspective, high 60s, mid 70s, and now being, high 70s, low 80s for WTI, I still see that we're down, at least from the Shell, the BP, and the Exxon perspective, about 30% or more. Chevron's relatively full value compared to where they were in 2018. But do you think that is mostly due to a lot of the institutional investors, the Norwegian funds leaving, the Rockefellers leaving? Like, do you think it's mostly because you had all these people that historically had made a lot of their money in the past and say the 20th century off oil and gas now leaving to go more toward these ESGs? Or do you think, and I guess secondarily, do you think, or how long do you think it'll take to make up that 30% wedge compared to where we are today, knowing that, in my opinion, it should go back. All these companies, Shell should go back to $75 a share. Exxon should go back to $80 a share. BP should go back to $45 a share. They're not there. They're 30% discounted from those prices. How long do we think it's going to take? Or do you think we'll never get back there because the institutional investors have left?
Tracy, go ahead if you heard that.
I did. In my personal opinion, I'm trying to put this nicely. I think that at this point, I don't think the majors are the place to be at if you're looking for returns on investment. I think that they're two on top of the fence, right? They've got one leg in ESG, and they're overpaying for assets like BP, for Shell and wind turbines. And they've got one foot in, on the ground in oil and gas. And to me, that just doesn't make an attractive proposition. And I think they're going to be hurt. Shell kind of got into the game a little bit earlier, so maybe they're going to do a little bit better. But somebody like BP that got into the ESG game a little bit later, that completely overpaying for assets, I think that's going to bite them in the end.
Yeah.
So if I were looking for returns, I would probably be looking at some of the like mid-tier, smaller cap companies. I think that will do better in this upturn in energy prices right now.
Yeah, and Tracy and I keep agreeing, but I wrote a report about how to avoid getting lost in transition, and the reality is the return profile for what a lot of those companies are investing in is well lower than what their upstream or oil and gas investments would have been, which then says what's the price of carbon that they're trying to put on those projects. And there's an embedded price of carbon in these companies. And so the reason they're trading at 3 times multiples is institutional investors. If you live in London, Boston, New York, or LA, and you're going to cocktail parties with your guys and gals that are friendly, and you say, hey, yeah, I love fossil fuels, generally you're not going to get talked to very much. But if you say, hey, I love wind and solar, you tend to actually do all right. And so there's this incentive of personality and belief that I don't think necessarily aligns with where, like I think Harold Hamm described it, Tracy, you might have even clipped it, of EQ versus IQ. The reality is like there's an IQ test of where is real return, and there's an embedded question of what's the price of carbon in these projects. And I think the issue is that price of carbon that's embedded in these valuations is too high. And if you're making investments that are in the renewable space as an integrated company, you're accepting a shrinking market cap philosophy. And that's been our belief. The thing that is interesting, though, is there are a handful of companies that have kind of carved and waved a new phase of attracting incremental capital at essentially a 0% cost of capital. And so you look at the Ørsteds of the world, Danish oil and natural gas, Dong Energy went from being a North Sea oil producer to the second largest wind producer, and it's had a huge multiple expansion. NextEra, the old Florida Power and Light, has seen a move of still having large nuclear, but moving into renewables, and has had, now it's the world's largest utility. And so there are, a handful of companies that are kind of pursuing enough on the renewable side that their multiples expanded. But like as a majority, I think that you're going to see, lower capital returns and just a hard wave of too much money going into too few projects that is lowering the returns. and that just makes it hard to make those long dated renewables projects work for the majors. I'm a big anti-hydrogen person from the standpoint. I like hydrogen as a whole, but I don't think that the electrolyzation of hydrogen is the right way to go. The world consumes a lot of gray hydrogen now. We need to green that up and reduce carbon around it, but we don't need to take renewable energy, electricity, and turn it into hydrogen. I think that's a flawed logic. And so there's like these policy statements that are moving forward around where a lot of the Euro majors are, because they've got long dated gas infrastructure that might fit better into transporting hydrogen versus natural gas, and they have a whole lot of lobbyists that are pushing in that direction. But I think the end day policy presents opportunities for alpha, and some of the policy statements that they're moving towards that I think Tracy was hitting is saying those stocks will underperform those that are a little less inclined in that direction.
So I guess that brings the second part to my kind of conversation, which I think you teed up perfectly, is I understand that a lot of these European super majors are really defocusing on the carbon intensity of like oil and gas projects, and they're moving into more of the renewable space. But as you guys alluded to, the renewable space is seeing a premium in terms of dollars, in terms of like price to earnings per share. The investors would rather pay, say, $30 for an earnings of share for, say, a NextEra Energy, or even more because of the recent earnings decline, versus, say, an Exxon, BP, or Shell, where they might be inclined only to pay a third of that at maybe $10, or say, $10 for every earnings per share, right? I mean, in that respect, I mean, you have Total, who has a 100 gigawatt goal by the 2030 timeframe. You have BP and Shell has a 50 gigawatt time by the 2030 timeframe. At what point will the market cap kind of catch up, knowing that NextEra only has 21 gigawatts right now, and they're valued at 170 billion, which is greater than Shell, or almost equivalent to Shell, and also greater than BP at the moment.
Now, I think the thing that you're hitting is this question of like these small bits of the business that can turn into growth engines that turn into large bits of the business and get a premium multiple. And Generac's an example, NextEra is one, and like Schlumberger probably has some of that, Baker has some of that. Some of the energy services companies are definitely front end exposed to the transition. What I'd say is, and this was one of the questions I had for Tracy, I'll draw the line. Like, I think the S&P energy sector will be, somewhere between 6 and 8% of the market in 2023. And so, we're talking about a doubling or tripling, in my belief, as far as where energy will peak in the S&P 500. And some of that is some of these small parts of the business will start flowing through, but some of it's just this return of cash model. And and the biggest components of the S&P 500 are these largest companies that you're asking about. So they'll get drug along. But the reality is it'll be some of the littler companies that are part of the S&P that'll really be up, multiple folds. Like I've talked about 2 and 3 baggers in the E&P space on this podcast in the past. As those companies happen, Exxon and Chevron will be up as big component, and Oxy as big components of the S&P. But like the reality is the go down market cap and look for a higher cash return and total return to shareholders. Plus, you don't have the direct exposure to some of these lower return projects. So, Tracy, if you were drawing a line in 2023, where's energy going to peak as a percent of the S&P 500?
Well, I mean, we're at what, 3% now?
Yeah.
I think we could go, 2023. I think we can easily gain 2 percentage points. I think that,
so 5.
Looking out to 2025, maybe a little bit more. But again, you have to be realistic into what companies you're going to invest in, right? You have to do your homework, right? I think the majors are not the place to be.
No, I agree.
I think
actually,
that you have much better things and something, in the smaller caps and in the mid tiers.
No, I think that Canada is really interesting. I don't cover anything. I've covered Meg and Synovus and Suncor in the past at a long time ago, but you think about $80 oil and hedges rolling off, and I don't know what the carbon markets and some of the policy statements get into, but like just the fundamentals of where those companies are, the C&Qs of the world, like that side just feels like they've been historically in a good position, and might be there again.
And they're doing extremely well. I mean, they are outperforming so far in 2021, still outperforming the majors.
Yeah. So, that's what I think Tracy's getting at as far as going down market cap of, Devon, Coterra, Pioneer. Like look at these littler companies. Look at the enterprises of the world. Like if you just, these aren't stock recommendations, and I could add a huge disclaimer to the end of this. These are like just trying to think through where you go down, given you were talking about a couple of the majors. And the issue is going to be, though, if these companies don't return their cash, like if the management teams aren't listening to this and they're like, I'm going to put more money in the drill bit, well, then you ought to just own Shell. Like just screw them. Like legitimately walk away. Like run away from these companies if they plow a bunch of company into North American oil and gas and blow the production models out of the water, and like destroy, like services costs go up dramatically. You're already at supply chain issues. Like legitimately just be like, I don't care about any of you companies that are based in Houston, Oklahoma City, or Denver, or Tulsa, or Dallas, or Midland, because you guys destroyed capital. I don't believe they're going to do that. And I'm saying that to everybody, but like if they do it, like legitimately the thing that I've spent the last 21 years on understanding North American E&P companies, like, I'm a freaking dinosaur. Like I'm a fossil, because you shouldn't pay any attention to them if they blow their cash and don't give it back to investors. Like you really shouldn't. Like it is and that would be a flaw. Hopefully they're hearing it, and I think they are. So I think 2022 they're going to return cash. I think 2023 they're going to return cash. I think the variable dividends, share repurchases, and base dividends are going to be big. But if they don't hear it, and the companies that don't hear it, the littler ones that like ramp their capital spending a ton, like legitimately sell their stock. Like just sell them. Like just say, hey, I didn't like that. I can own a bigger company that isn't doing something stupid, or I can own a Euro major that actually is giving me a high yield, or I can own a Canadian company that's giving me a high yield, because bonds aren't returning a yield. And so like just like there's a bunch of retail people on here, but like vote with your dollars, and like legitimately get on EFT and like just crap all over them, because they really are those bad companies. I don't think they are right now, and I'm not advocating that they're going to do that. But man, I will write and be aggressively against any company that doesn't show capital discipline, because they could blow the market up again amidst like what I see as a demand recovery and supply constraint.
So I guess I'm curious, talking about that. I mean, you keep saying, and I don't necessarily disagree, but I think going from a 3% percentage of the S&P to a 5% over the next, say, 18 months is aggressive, right? I don't see a lot of these oil and gas proponents increasing by about 60%, which is what you'd anticipate going from 3% to 5% over the next 18 months. I find it very hard to believe. Do you think that a lot of that's going to be the Devons, the Oxys of the world doubling production coupled with hedges rolling off? Or I'm just trying to understand where you're trying to get these numbers.
I think you're going to have companies that have 20 and 30% free cash yield pricing down to 8 to 12% free cash yield. And so that's a doubling.
We've had I believe it's Chris, unless he just left. He was raising his hand forever.
Price or increase in production?
I think it's where the current prices are and where the prices are going to be, and they don't have to increase production. So on a per share basis, like there are two components, and the best correlation of stock price performance in the upstream space is debt adjusted cash flow per share. And so your debt's going down, your share count's going down, and your cash flow is going up. And your cash flow is going up by commodity price and modest production, but your share count's going down and your debt's going down. And so I think you've got doubles. I mean, it's that old, 6th sense moment of I see dead people, I see doubles. Like I legitimately don't see doubles. And the S&P 500 E&P index was one of the energy stocks were one of the best performers last year. I think they were the best performing group overall in the index, and I still see doubles. And like that isn't, not a trivial thing, and that's where I think 6 to 8% in 2023 waiting. And I think while that happens, there's some headwinds for the rest of the market. But I think energy as a whole is just pricing to a reasonable yield without and that isn't even running $80 oil. But so I think there's a lot of different ways to win.
We had a.
I understand that. Sorry,
I was going to say, Chris had been raising his hand for a while. Chris, what do you got?
Hey guys, pretty much the synopsis of everything I get to hear when I join these kinds of spaces or any of these chats is the question really relies more so on the demand side, any sort of exogenous things, or whether or not the extrapolations of current demand and projections for current demand will really hold up into the years and into the decade. Because everything I've gotten from pretty much everyone who's in the know is that supply is going to be between constrained to significantly constrained to exceptionally constrained. So the question there is, or the premise there is exceedingly positive for the space as a whole. My question really resolves into China as the source of major energy demand for the last decade, or U.S. current consumption patterns like durables being heavily bid this year compared to what has historically been the norm, and how durables kind of musket in the sense that you have to take quite a while to reload on them, or how transitioning in the short term for this Omicron variant and how it tends to be exceptionally infectious, and while that means severity appears lower and ultimate outcomes appear better, it also means that you're having 2, 3, 4% of the workforce go offline for 5, 10 days at a time, depending on what industry they're in. So I guess if I had to throw a wrench into the energy thesis, it would probably be, what does demand do now? What does demand do next year, the next 3 years? Are there any sort of major exogenous catalysts like March 2020, April 2020 that get thrown into the mix that aren't necessarily energy positive? That's the stuff I'd probably want to speak towards.
Can I answer this question?
Yeah.
Please.
All right. So here's what my thinking on this. Well, and I'm not an epidemiologist, obviously, but Omicron looks to be slightly less horrible than the Delta version. It seems to be less hospitalizations, less. So in the interim, I think that's something to be considered. But really, if we're talking about demand in general, overall, there has been no observation.
Oh, no.
Sorry.
What?
Go ahead. I don't know what that was.
So we're talking about demand in general. Demand was over 100 million barrels per day, according to BP, at the end of 2021, which is literally almost more than 2019. So demand's not going away, right? And that has to do with a lot of factors. Considering this, so I don't think you're going to see demand going away anytime soon. And I think that this new variant is going to be incrementally less invasive than it has been before, because you're already seeing the narrative change in the United States. Nobody wants to shut down. Everybody wants to open up schools. So it's not. I don't think you're going to see this. We do see this problem pervasive in Europe, but we're not going to see that in the United States. The United States is the number one leading consumer of oil in the entire world at over 20 million barrels per day. So, and that keeps increasing. And I have a chart. I'll post a chart to show you the increase that's been happening since the bottom of 2020 hell. But we're almost over what we were at 2019. And again, the world's largest leading consumer. I mean, everybody talks about China being the largest buyer, but it doesn't really matter. It doesn't matter how much you buy. How much do you consume? We consume a lot. In fact, we consume more than the entire planet put together.
Yeah, I think that the demand side, and this gets into policy of blue collar workers globally are being asked to shoulder the cost of the rich. And so like there's this hard choice of elected officials that want the blue collar vote, as you have escalating commodity prices, and like how does that impact demand? And like that's probably the one policy thing that I worry a little bit about, like, onshoring of activity versus offshoring. In my when I got an MBA, there was definitely an offshoring trend that now we're moving back into onshoring that feeds more inflation and more capital deployment. But like the policy side of trying to win elections in the U.S. are on a 2 and 4 year cycle, and we're in this like 2022 escalation in all commodities. Like that worry of like what does that mean? From a you look at what's going on in Kazakhstan today of, true unrest as opposed to the, storming of our capital in America. Like there's a question of like, true unrest happens whenever you don't have cheap food and cheap and reliable power.
Exactly.
And that's the thing I worry a little bit about, like on the demand side, but it's not, and then long dated. I do think that, Matt, you hit it and I talked about it. Like the policy of China for 20 years has been, we need to figure out how to get all our workers because we have a growing workforce. China's workforce is plateauing and declining in the next 7 years. And so like the Chinese policy is shifting from build more to have a better financial system so we can consume more. And that changes the dynamics of dollar and currencies that I think is a little bit unnerving for people like me that don't think enough about those things around, because the dollar drives where oil prices will be. But the next year, I don't see how it changes. Like so the demand side is something I think a lot about, but I really do think that coming out of COVID in a world where we can prevent infections better through vaccines, behaviors, and lifestyles, where we can treat infections better through new drugs that are going to be implemented. Pfizer and Merck have drugs out that, when they're fully implemented, no one should die of COVID. Like it's legitimately, they're phenomenal outcomes. Like it's like the biotech world is doing great things. And then we have old drugs that are, causing the outcomes of mortality lower, whether or not that's fluvoxamide or butacyanide or hypertonic saline nasal rinses. And then the hospitals, like we got a freaking bunch of ninjas globally that are ICU doctors and nurses that are way more knowledgeable. And so like I look at the post-COVID care and like the post-COVID outcome of that worry. And I just think that, we're in a different situation than we were in that very uncertain time in 2020. And that I think is where demand is going to surprise to the upside. We're not traveling. I hope to be traveling in the first quarter of this year from a business standpoint. We're not. No one wants to see us, and that is a headwind. But we are traveling personally. I don't know if everybody on the call, like how many vacations have you thought about taking? That is up a lot. And so I think that the business travel side is one thing that'll be important globally going through the second quarter, third quarter, and fourth quarter. And Tracy, you've hit it. I think that people are looking at trying to just get back to 2019 levels. If you go back to the IEA reports, the oil market reports from September, October, November, December of 2019, we're talking about being at like 102 to 103 million barrels a day of global oil demand, not just getting back to 2019 levels as we looked forward just a year. And so I think that's the thing that everybody's fighting last war, which is get back to a level. And I think they're missing that, like there's pent up, onboarding of capacity, there's pent up business travel, there's pent up personal travel. And I think that the energy transition hasn't absorbed that much demand. And then we just have a lack of supply. So that's my take on demand.
I do agree with you. I think that demand will increase throughout the rest of the decade and really start to subside maybe the latter half, like maybe late 2028 and going into 2030 time frame. There's still a lot of carbon intensity that still needs to go into getting the grid ready for these renewables. And that, of course, requires oil and gas to be able to mine and be able to get the infrastructure ready to be able to even handle a new next generation world where we could actually even think about transitioning and using natural gas as a transition fuel to get to where we want to be with all these renewables that people think are just going to come out of nowhere. And I think it's very interesting if you listen to some of these policymakers. It's as if like we don't even need oil and gas anymore. But like you've mentioned, it's not about just matching where we were back in 2019 with 102 million barrels a day of demand. It's going to increase to 110, 115 million barrels a day before we even start to get to the point where we hit some sort of peak production. And every time we have another year or two down the road, the pendulum swings back and people recognize that peak oil continues to move further and further along. So you have great nations in Africa, Indonesia, Southeast Asia that are decades away from getting to where Europe and the United States are with respect to, revolutionizing their grids towards renewables. And I don't think people recognize that because like you said, you go to the bars in the UK or the pubs in the UK and you get laughed at if you support oil and gas. And I've experienced that myself, when I was traveling in the Caribbean and I met some UK folks and they said, "You're a petroleum engineer? Isn't that industry dead?" And it's like,
no, I did a road show through Houston, Dallas, Denver, Oklahoma City, Tulsa. And there were people in Denver that were like, I work in the energy business, and we've got one of our analysts that does about 20% of his time on energy transition, and he's a young, attractive guy in New Orleans, and he's like, and whenever he's trying to pick up two-lane girls, he's like, I raise money for energy transition companies, even though that's a small amount of his time. And because if you're in oil and gas, like, it's a stigma. It used to be cool to be that, but it just isn't. I mean, Tracy, we've gone a while.
She dropped off again. It keeps going back and forth. And I know Josh had been trying to get on. And real quick on that last topic, though, I felt like what you just said, Hike, about the kind of stigma around it. And I was like probably last year and the year before kind of in that mode. But lately I've just decided that just to lean in and just embrace it and still be proud of it. So anybody else that's in oil and gas in here, you should do that too, because we're powering the modern world. So just FYI, don't be ashamed of it. But Josh, what do you got?
Hey, yeah. So I agree, and Alex Epstein and some other guys really do good work on that in terms of what we're doing for the world, I think. And I guess I'll include Lee as I help fund some of these things. So I guess my question, I hear you guys. I think I generally agree, Hike, with your take and Tracy's take. I do lean more towards smaller companies, which, if you're bullish, to me seems like a natural place to go, because in bull markets, smaller companies seem to outperform, and then also towards companies that are kind of more of a public LBO, which again in a bull market would seem to do better. And obviously with a measured risk approach, that would seem to be based on what you're saying, I would have thought that would have been the place to go. And I get from an institutional perspective, if you go to XYZ fund manager that needs to deploy an amount of capital, maybe that's not a good fit. But, with a bunch of essentially retail people here on the call and just you could deploy a small number of dollars instead of large, wouldn't that be where you'd look? And if not, like, what am I missing there?
It's that's an interesting question of how to answer. I mean, we think that probably some of the best opportunities is in the fact that you're going to see M&A and consolidation in the space as well. And so there's like private companies that are going to get consolidated, whether or not that's, Crown Quest or Colgate, or there's the Smashcos of NCAP that are in the Permian. You have stocks like PDCE and the Civitas that are in Colorado that are trading at really low multiples. There's this like question of sustainability and like, do you matter? And I think that's the hard part for the small companies is they legitimately can't get people's attention to get real money to invest in them beyond retail. And I think that's going to be the hardest part. And so there's this value gap versus like, where are you on the spectrum? But there are, you don't have to go down market cap a ton, but that middle tier, I almost worry a little bit about the $5 to $15 billion market caps of companies that are going to do big or medium-sized acquisitions, and then you have private equity selling shareholder overhangs. in the upstream space that kind of worries me a little bit. So, the big companies are in a position where they can do a deal, and we've done a bunch of modeling at PEP Insights around a lot of these deals actually could become free cash accretive to where their acquisitions are. So free cash yield of what you bought is above what your current company is, and that's going to work all day long. It's just a question of price. And so, these mid and small caps, like where do they get into the, actually attracting, the institutional buyer? It's just hard to see them really get there. That's been our biggest issue.
If I may, maybe I can present the counter to that, and then I'm interested in your response, and then I'll, the point is to argue it just to try to explore and better understand. So I guess the counter to that would be that the larger companies require institutional investment, and there's been institutional divestment. So if you go to a $20 billion company, you need multi-billion-dollar funds buying it. If you go to a $500 million company, you don't. And so I get, again, from getting paid on advisory or getting paid on trading shares, that's a different sort of world, and it's maybe not fair because that's your world to some extent.
Yeah,
and
I mean, so the people that I talk to every day are, $500+ million to, multi-trillion-dollar asset managers, and the driver of trends in the past has been like the factors that you would own are those like the most corrupt management team with the lowest margin assets and the worst balance sheet, and that's what would drive it. I think that size and profitability factors are going to drive things this year, because I think that the S&P 500 rating and weighting is going to double. That's the play that I'm purely playing a macro, like, your generalist at Putnam or Eaton Vance or those groups are going to look at it and say, wow, energy is outperformed in 2021. Oil's up a lot year over year. Give me something that is okay. And I hate to list names, but like something that is, mid cap, large cap versus small cap, even if oil goes to 100. So that's I just think of reweight in 2022 is going to be the first wave of the trade. And then once you've had that re-rate of all these large caps, that's where, Josh, I think you start working. And so it's this patience factor. If you get, a large cap E&P that trades from 3.5 to 5 times, but you still have a mid cap, trading at 2 times, you can still go to 4, but I think you have to have the first step that drags everybody in, where they're like, okay, so now I've missed Pioneer doubling or up 50%. What can I buy that's the down market? So it's a little bit of tactical trading that maybe I'm hitting. But by the end in 2023, for energy to be at a 8% weight, all these things are going to win. Like, you can own any of them. Like, it's like, fish in a barrel. Like, I'm not trying to, like, there may be some, we look for alpha. Our model is we're looking for spreads between companies, but like last year, the clients that we have that did the best were the ones that could have a directional bent. And if you're a retail investor, you have a positive directional bias towards the space, and you're going to outperform, is my belief. And I think the thing that we haven't talked a lot about is start sniffing out some carbon angle. And I know I'm just going to plant that seed. We've gone long in this call, but like the carbon angle, those companies that reorged, have less debt, and have a carbon angle are probably my most exciting public equities at the moment. And Josh, they kind of fit into that small mid cap space that you're hitting. So they got clean balance sheets, and they're not necessarily well owned because they're kind of owned by former debt holders that now own the equity. There are a few handfuls, one or two that stand out. to me.
Thank you guys for doing this. Tracy's dropped a couple times. Her connection's bad. She said, thanks. She said she wants to do another one. She said she has more to say, and LOL. And I said, yeah, I know. So, we'll get her probably on like a recorded one. The Twitter Spaces things is fun. There's like 400 people in here. I appreciate everybody listening. We do this every Friday. The Talk Energy Insights. It's David Heikkinen and myself. We got the regular Talk Energy podcast. It's you can find us, follow us on Twitter, subscribe to the pod. We'll post this to the audio version to the podcast app afterwards, and we'll be here probably next Friday again. Thank you guys. Hike, what else you got?
That's it. Happy New Year, everybody, and thanks for your time.
All right, guys. Appreciate it. Have a good weekend.
Thanks, gentlemen.